Good afternoon and welcome everyone to this TradeStation Lab Spotlight On series. My name is Fred Pomleden and I will be your host this afternoon. Today's presenter is Linda Raschke, President of the LBR Group. We'll get Linda started in just a minute, but first let me cover a few things. First, let me familiarize yourself with the broadcasting tool. You can submit questions in the chat area in the lower portion of your screen. Now, the chat is not privatized, meaning that everyone in attendance will be able to see your questions or comments. I will answer general questions related to TradeStation, and I'll let Linda handle questions regarding her presentation. But please do keep the questions on topic. Also, today's presentation will be archived and available for you on the TradeStation website. It may take a few days before the archive is posted. If you have trouble viewing this presentation, or if you have problems with the sound, you can click on the blue X on the top right of the window to refresh the connection. Also, if you get disconnected, just log on again and you should be able to join the room. Now, you may need to adjust your computer volume. Volume, of course, can be adjusted directly on your machine. But notice that there's also a volume slider at the bottom left of this window. Now, let's get some legal matters out of the way. The following presentation is for educational purposes only. All symbols and trading ideas discussed by the instructors are for demonstration purposes only and are not recommendations. Also, active trading is not suitable for everyone. So please read the disclosure information in the PDF handout available in the Documents folder in the bottom right of the viewer or on the TradeStation website. Now, let me mention some upcoming events. There's a special options event coming up on July 23rd with Larry McMillan. And there's also an FX event on the 25th. So for more information on these events or other upcoming events, please go to the TradeStation website for details. So today's presenter is Linda Raschke, President of the LBR Group, a registered CTA and money management firm. Linda will draw on her extensive experience with market profile for this event. The title of the presentation is Best in Show, Combining Swing Techniques and Market Profile Concepts. It's great to have Linda here sharing her trading knowledge. Now, Linda, it's all yours.
Thank you. Can everybody hear me okay? This is just a quick test. All righty then. If everybody can hear okay, we'll get started. I only have an hour here, and I want to thank TradeStation for the courtesy of having me on to do a presentation for you today. You know, I always have to say that a lot of times when I put these things together, I'm always putting them together for myself as well. You know, it's always solidifying the concepts that work best for us. And there's so much noise and so many indicators and so many distractions. We have to constantly remind ourselves to come back to how can we simplify things and reduce it down to just a few key things to follow. Because trust me, if you sit there and try to look at too many indicators or get too many ideas in your head, it's brain fry so easily. So what we want to do is combine a way of finding simple roadmaps to follow the market's action with the conceptual framework. So what I'm going to do today is to present to you combining both some very simple essence of swing trading with the market profile. And I thought this was appropriate for two reasons. First, there's a plethora of market profile information, chat rooms, this, that, software on the internet today. It's actually something that was originated many years ago when we had pit session only and was for floor traders on the trading floor. And so a lot of it's sort of been bastardized, if you will, and there's nothing wrong with that. It's just changed a little bit in the way that it's oriented. It still is very useful because it provides concepts which we can't necessarily pick up off of the traditional swing charts. Now, swing trading and our traditional bar charts have the main difference is that they'll have the time access. And so I find that very often, especially with newer traders, it's very easy to get too caught up in simple things like 5-minute bar charts and oscillators, and all of a sudden you're shorting on what you think is a 5-minute bear flag, and all of a sudden it flies up in your head in the opposite direction. So what we want to do is we want to keep the swing trading concepts, but yet also increase our awareness of what is the market doing, okay? What is the market doing regardless of if it's a 5 or a 15 or a 1 or a 30-minute time frame. And I think that this is something that's been a little bit lost with newer people, studying traditional technical analysis. You were very much aware of it if you were starting out on the trading floor, because we didn't have, bar charts and computers and so forth. So let's see how we can take the best of both and present it into a nice usable little format. Now, two things just as resources for you. I love the Jim Dalton Mind Over Market book, and what I'm going to do is I'm going to pluck out maybe 8 of the most pertinent pages that to me are really the essence of it. So we'll look at this in the presentation today. And then lastly, you'll see some market profile charts on my slides that are on TradeStation. And it's not part of the normal TradeStation indicators that are pre-built into the application. However, this is code that is available to you for free, hey. And so we'll find out a way that everybody can download this so that you can use it or play around with it as you wish. It's not something that I actively use during the trading day, but it'll help serve as an illustration for some nice concepts for you. So let's start off right off the bat. Both market profile and swing trading are ways of defining some type of market structure. With swing trading, and you can see I'm just going to briefly review these slides, I think that what's gotten lost in the essence of the market profile dogma that's out there right now is the importance of the swing highs and swing lows. So for me, when I come in the trading day, I'm always most aware of the previous day's high and low. 95% of the time, one of those levels will be tested. And obviously, people are very aware of the intraday highs and lows. So for me, that dominates. These are the most visible chart points out there. And so for me, that's why I can discard the Fibonacci and the Gann and the traders pivots and all these other things, which are excellent in terms of having value as a tape reading tool for you, but not all market participants, such as institutional players or the small scalpers or whatever, are aware of the same level. So I want to see how the market tests highs and lows that everybody can see. And then we can take these and we can define a quantifiable structure. So it's black and white. There is no gray area in saying that resistance has been defined or support has defined. And then we can build on this and look at chart formations, and we'll look at a couple examples of this. With the swing trading structure, it's really important to me that we can quantify things, and by that I mean simply I could put it to a computer and the computer would say this is an uptrend or this is a downtrend or blah blah blah, and we'll look at how you can do this. But again, it just eliminates those gray areas where all of us, myself included, often want to see what we want to see. And I think you know what I'm talking about there. And that's something we need to be a little bit careful of with more like market profile, where there's a little bit more gray area. I just want you to recognize the dangers too of using a technique or a methodology where there is a lot of gray area, because it's so often easy for us to interpret what we want to see and then think that that's what's going to happen. Obviously, you all are familiar with the primary things that traders during the day will follow the market's action. Can we retest up? Is the test down making a higher low? Are we forming a breakout coil? And so forth and so forth. Now, just to drive home a point, I thought it was particularly cool this morning, and if you can see my mouse here, this is where we opened on this morning, and we always joke, I like the expression, all traders are watching the same movie. You know, we all see the same thing out there. So it was pretty interesting the way we tested this key previous swing high to the tick, and if you had had a large resting order there, you may not have gotten filled on all of that, because it did not trade much volume there on that test. And actually, it was a similar data point way over to the left, exactly to the tick. So if you don't think that there's so much importance around these previous swing highs and previous swing lows, this morning was an excellent illustration of that. And of course, if you drew a line right across here, we failed on the push of this little range in here to the upside and fell back into it. So very often when we fail on the upside push, we look for the downside test. And I'm sure everybody had that 1343.5 number in their mind, that 1343 level, because that was this previous swing low. And so a lot of times with the swing trading for simple tape reading purposes, we are watching to see how the market trades around these previous swing highs and lows. And that is really an edge that a discretionary trader will have over a machine, is that you are better able to process relationships, how something's trading around a previous high or low, much better than an algorithm or a mechanical system. So just believe me when I tell you that you actually do have an edge in watching the trading around these areas. So what happened when we blew through this, notice we actually went down and tested these previous highs right to the tick. So this was a very important support area. Another concept when we look at the swing trading and the structure, 2 data points make a resistance. So you could say that this right here was your initial resistance, and data points that were previous resistance now become support. So these are like old adages. They're just, they don't work 100% of the time, obviously, but they work enough of the time just to be aware of them. So now what happened? We're between a rock and a hard place. We came down and found support, and then you notice that the first little bump up, this is a 10,000 tick chart, so it's not going to show up so clearly, but the first little bump up backed off, just maybe 4 to 6 ticks off of that before the market decided to come back into that trading range. So with this traditional structure, which was used by Wyckoff, who in my regards is the greatest contributor to overall technical analysis, and I would, if I had to subscribe to one method of following the market, I would definitely subscribe to using Wyckoff approach. He would simply call these little false breakouts from trading ranges bull traps or bear traps. So you could say this was a little mini bear trap because we flushed below that swing low and then, of course, came back up above it. So that was just this morning, and I only wanted to point out the importance of swing highs and swing lows, that they are probably watched more than any other data point by the most amount of market participants. And this was another example that just came up today. We can drill down to all sorts of time frames, but the bonds also trade particularly technically in terms of everybody is watching these key swing lows and swing highs. And so therefore, we had our initial support on numerous tests there, which eventually got broken, and that led to the downtrend. So I don't want to elaborate this point, but that for me is the essence of these swing highs and swing lows that come with traditional swing trading, just following the length up and down. So let's move on, and you know that trends are defined by 2 lower highs or 2 higher lows. So obviously on this 480-minute time, oh, this is a daily chart of the EC, and you can see right here we've got 1 lower high, 2 lower high. We have a downtrend. It's not well established at this point, but we can then use the shape of the swings, just very basic traditional concepts here. This downswing was greater than the previous downswing and greater than the previous upswing. So this is very obvious that you had a breakdown, an increase in momentum, and now you're looking for the shorts. So another increase in momentum to the downside. Here is a breakout coil. All coils have 5 data points. And again, these data points are the structures from the swings. And now you can see on this last daily leg, finally this last daily leg was shorter than the previous daily leg. So it's showing a loss of momentum. That does not make for a trend reversal. But these are the classic time and tested rules, if you will, that will serve us when looking for a bias. So obviously, when we're making our trading decisions, you can't be looking to go long and then go short and then go long and then go short. You have to understand that both market profile and swing trading or structure, however you want to call it, involve following the market. Of course, they're not forecasting tools, but they do give us probabilities, all right? So they are both statistically oriented in that they give us probabilities as to should we be looking for the long side or the short side. So here, you might be looking to cover your shorts on loss of momentum, not necessarily to make a aggressive counter trend trade. All right, let's see. I'm getting a feedback here that there's a little laser pointer in the drawing tools, pencil icon up here. So, oh, cool. This is awesome. All right. Well, let me get back out of here. All right. So let's, you get my point that we got our basic structure, our overall structure on whatever time frame you're trading on. For me, the swing highs and the swing lows, and this is how the chart formations are formed. This is, again, trend, support, resistance, momentum, and there you go. You got a nice bag of tricks there. 90% of the tools are right there. And from then, of course, you can add multiple time frames to fine-tune or drill down to find points to manage risk more appropriately, or entry triggers appropriately, or where we would want to be looking to at least tighten stops or take off the trade when you start to see that loss of momentum. And this, I just went down to a 480-minute chart, and this is just my little classic, ooh, I got a nice big thing here. My little classic 310 oscillator that I like to use. There's no right or wrong on any of these things here. And again, you can see on this last leg down, the EC started to find some loss of momentum with some divergence. So you would definitely want to tighten your stops or exit trades, or however you're managing that position. And trust me, I have yet to be successful in consistently selling up here and buying down here. It doesn't work that way. It just looks lovely in hindsight, doesn't it? Okay. And then lastly, if we drill down just to a 5-minute chart, this was that reaction back up. So you can see here we had a 480-minute time frame, and then we go down to a 5-minute time frame, and you can start to see 1, 2, 3 higher lows. So once I start to see that on that time frame, I might look to scalp in the other direction. So this is something that market profile does not show us, that looking at the intraday structure will, and that is that we can have multiple time frames. We can have an uptrend on a short time frame at the same time that we have a downtrend on the higher time frame. And just to be clear what time frame that you're trading on. So if I'm trading on a 5-minute time frame, that's just fine to make long trades, and just recognize that it's scalps and the swings set your risk-reward structure. This is another lecture for another time, but there's nothing to say that you can't look to trade for little tests of swing highs on the way up, and so forth and so forth. So at any rate, I assume that these slides will be there for you to review going forward, and if not, you can certainly email me and I will make them available for you as well. So let's go on and see now how this looks at market profile, because ultimately I just wanted to lay a little bit of foundation for things that you guys already know. I know that you guys already know all the bar charts and the swing highs and swing lows and structure and the basics and stuff, because really it's not a matter of knowing it, it's just a matter of conditioning yourself to feel comfortable with it, just looking at a chart and immediately being able to grasp the overall structure. And this is something that always improves with time. The more charts you look, the more charts you study, you know, you get better and better at it. And that's true with market profile or anything. So just here we are now with that same 5-minute swing up. You can see here was our little 5-minute swing up. And now let's look and see at what this would look like on the daily profile. So what it does is it's condensed the areas of trading and squished them all together sideways so that we can see a bulk of trading took place around this level. Now we'll review the most important market profile concepts and see what comes out of that then. But for now, we just want to note that we had a trading range down here. You can see we had a markup, a push away from this, formed another consolidation in here, and had a markup and a push away from this, holding our gains. So it's pretty straightforward. All right, so let's just now look at some basic market profile concepts, and then we're going to extract what is the most practical things that we can keep in mind for our trading. And just real quickly, that time equals price. So you can see that this was also a concept that was put out there by Gann in a different way. This price equals time, and you saw that today when we had that big markup in the morning session, that we had to consolidate all afternoon to do that price equals time. So the more that we held up here this afternoon, the better off it was saying that we had accepted this new price level, this markup to 1356 to 1359 area in the S&Ps. All right, that is the opposite of price rejection, where you test and you reject and you don't hold those levels. So this is something that ties in with market profile as well. The more price trades at a certain area, the more it's considered a fair price. It's a value area. It's where both sides of the parties have come into agreements. And again, you can see the false breakouts from the trading ranges quickly lead back into the trading ranges if they're not agreed upon, that breakout price is not agreed upon by both sides. And if volume is always the best indicator too. I know that most of you are familiar with market profile terms at this point because they have been so bandied about on the internet. And let me caution you, there are a lot of people that misuse these things, so always do your own studying too. There's lots of information you can read on the internet, and I would advise you, for the small price of Jim Dalton's book, I think it's his first book is one of the best ones that you can own in your library, if only for these 10 to 20 select pages that we'll review. But just in case, the initial balance, so one thing that's useful with market profile is understanding the importance of where price opens and then how we trade off of that opening. Now, first question that comes up, but what do we do with these 24-hour sessions? And that is the beauty about being able to take a concept, okay? We don't have to be literal. We can take a concept. So for what I like to do is I like to use the start of the Asia session. I'll use the start of the European session. And for the US session, for all markets, I use the 7 a.m. reading, except for the E-minis where I can use the NYSE stock opening. Okay? So what's really important is that you understand the opening of these sessions is where you're going to get that country's or that group of players' initial trading. And that's what we want to see. When the market opens or when we get those players coming, and say, for example, I'm using 7 a.m. Central Standard Time for the bonds, for the gold, for the EC. What is that? That's the New York boys sitting down at their desks at 8 a.m. in the morning. And that's when you start to see the action pick up. So I want to see, are the boys around today? Is the volume there, the boys and girls, excuse me, or are they still out at the Hamptons? In which case, volume's going to be lighter and it's going to be a different tone of day. So we'll drill down and see the real implications here in understanding how the market forms a range right when that first group of players sit down. And if you're in another part of the world, take this same concept and think about when the European session opens, looking at that first 30-minute bar. Did they open and did you get an immediate range expansion, or did we open and did we form this early hour of trading? And you can use that in a different session hour as well. Range extension would be the move outside the first hour's range, and of course we all see that the market's so much more urgent these days that you can almost use the first 30-minute bar instead of the first hour. Value area is just simply a statistical term. It's something that changes during the day. It's a certain standard deviation of the range during the day. And the tricky thing is that value areas can change every hour of the day. So that's why I want to bring us back home to the importance of the swing highs and the swing lows that are visible chart points, as opposed to what is the high of a value area, which is less likely to be significant. It's just a general area. Okay, not everybody sees it on their charts. So it's a concept. It's not the same data point that a swing high would be. Single print buying tail or so forth, or selling tail, just another cliche for price rejection. Hammer on a candlestick, and you'll see that so much of what we look at with market profile versus swing trading, it's really a matter of semantics, guys. You know, it's just using a different language to say similar things. All right, so it's just all the same movie again. Point of control, all right, I don't put much credence into that. It's just a general area that the market will gravitate towards where a lot of prior trading has taken place. So enough said about all that. Let's get down to more practical stuff because we want to start thinking about how does the price trade off the opening. So one of the things that Dalton's book will show us is this concept of open drive, open test, reject, and so forth. And we'll look at some examples about this. But this right here, so you can see this right here and this right here are, to me, the essence of the most important parts of market profile. All right? This is what I like to use from a conceptual standpoint is, how are we trading off the opening? Does it give me signs that this could be a trend day? Am I seeing the range expansion in that first 30 minutes? Is it accompanied by an increase in volume, for which I like to use the first 30 minutes of the NYSE sessions volume? That's what I use, and believe me, it works as good, if not better, than anything else for setting the whole entire tone for the currencies, for the credit markets, for the old financials and gold and silver and crude and so forth, but in particular for our index futures. The NYSE volume seems to be a proxy for capital flows, for these global capital flows, and that's what we are dealing with in this time and day and age. It is one big sloshing of global capital flows, and that's why you see this incredible correlation for the last number of years between the gold, the silver, the EC, the dollar, the crude, the S&Ps. It's not perfect, of course, it's not perfect, but it's there, stronger than it was 10 years ago and stronger than it was 20 years ago. So I believe there's a lot to just simply using volume in the NYSE as a proxy for a lot of different markets. And so when we look at this open, is there increase in range and is there increase in volume? What is that going to tell us for the rest of the day? And conversely, if we have the opposite. So, number one, what kind of strategy are we going to use for that day? So if we start off with a day where the volume's not there and you get a little bit of rotation around the opening price, there's no significant gaps, this might be a day to be careful about looking for 5-minute bull flags and 5-minute bear flags where you might just be testing in a range, and we don't want to use continuation patterns when we don't have the volume there to support driving a trend. See? So on those types of days, market profile people love to look for fading or making a counter trend trade in that initial morning session. And I would recommend paying attention to the volume. When you do this, you'll have better odds of making a counter trend trade when that volume is not so significant. Also, in the morning session, there's much greater uncertainty out there and the market does more testing. So once again, if the volume's not as strong, you'll have better odds of making counter trend trades in the morning session. And this is where, again, people like to put up their little market profile value areas. And we'll look at some chart examples to see how this developed. However, how many times have we all learned the hard way, getting run over, trying to make a counter trend trade when we have that strong open drive sequence? The reason you want to be careful with the open drive, which means the market opens up and it really doesn't trade much above that opening price, or vice versa, and immediately starts moving in a directional bias with an increase in volume. What does that tell us? It tells us that you have the institutional players on board and there's a certain urgency to getting on positions right away. And this is where the VWAP has become their tool of their weapon of mass destruction, if you will. They get very aggressive in trying to beat that VWAP, which you can only do if you put it on very early. And so we only get maybe 2 strong trend days a month, all right? So it does not happen so often, but you want to be careful when you have that strong open drive sequence. So let's just look at one or two more points, and then we'll look at some charts. The other thing to consider is, where did the market open relative to the previous day's range? A market profile phrase that I love that really sort of brings it right to our awareness is gap outside of value area, which means that basically the market had a big gap up or down. Okay, you can also look at the gap relative to the previous day's high or low and so forth. But it's just a little catchy phrase with the market profile, gap outside value area, because when we have a gap outside value area, you have increased your odds that there's a trend. And why? Because the market is out of balance. Value area has been where the most people agreed on a general range. The buyers and the sellers have kicked the football back and forth on the 50-yard line here, and you just have a nice little trading range. When you gap outside of that, one side is out of balance. So either the bulls are caught flat-footed or the bears are caught flat-footed, in whichever way it starts to move. So that's why we can get better trends sometimes when we gap outside that area. The opposite side is when we open within the previous day's range and have initial balance. So we'll go into this just a little bit more when we look at some concrete examples. But this is in the market profile book that Jim Dalton wrote. And just briefly, open auction. Okay, open auction, you'll see the market fluctuating around the opening price in the first hour. And if there's not increase in volume, very likely it's going to continue to be a trading range type of day. Nothing wrong with that. You would just want to make sure that you didn't have a breakout from that first hour's range with a significant increase in volume. Open drive, I know that we have seen this probably a higher percentage of time in the last 2 to 3 years than we would have like 10 or 15 years ago. This represents this increase in urgency. But I know that you know what I'm talking about with some of the previous trading sessions we've had, where the market gaps up and continues and just never trades below that opening price and is a trend day up. We'll look at a couple examples of that. Now, this is basically what we had this morning. A big open, and the market did a sharp drive in one direction, and then it tested and sharply reversed in the other direction. So you can get, instead of an open drive, this open drive reject or so forth. You know, this is all semantics. So, you know, you can read, there's about 2 pages on each of these descriptions. And I think sometimes if I look at charts here, it'll show a little bit better. Now, I don't want to elaborate this, but I just wanted to include these slides for you. We've got so much more material to cover, but this was the other important part of the market profile that made a difference, I think, in a lot of people's tradings. Just understanding that the types of days can basically be summarized in about 6 different types of days. And today was actually what I would call a normal day. We had a very wide range in that early AM session, and a lot of times this is caused by news. And the news this morning was Bernanke's testifying and giving his yada, 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 yada as to, like, was the Fed, you know, in a position where they were going to do more stimulus or whatever. The market was waiting for this. And so the minute that his text was initially, bam, you had the selling come in because he didn't give concrete action or plan or whatever the news media wants to say later on. It doesn't really matter. I just think that the market was waiting for a trigger. You had some news, and it caused that large initial dog pile, if you will, from an overly long market right there. So this was a very wide range in the morning session. We had a strong test and then a strong reject back up into the range. So that's how I would categorize the normal variation day. You can study all this on your own. Trend days, I think, are probably the most important type of framework to understand. And not only that, they will also appear in multiple markets. So if you're going to have a trend day in the E-minis, you'll have trend days in the currencies and the bonds most likely as well. Very important to understand that you have a trend day underway for two reasons. Okay, the first is that our strategy that we're trading with is not to make counter trends, and instead to understand that that market has a very high odds of closing at one end of its range. That would be a sign of a trend day. So it's a pity if you think you're going to go and scalp off little 2-minute little flags or something to take your 4 ticks and then watch the market run another 8 points. So the real power of a trend day is understanding that, hey, here's a day where you can tee it up, you can leverage it a little bit more, you can press your trades and let your winners run. And unfortunately, the market never gives us as many as we would like. So here's just an example of how it might happen out of you had a little early range so that you can get trend days that come out of morning consolidation as well. And then, of course, the impulse, the range expansion always indicates a supply-demand imbalance. And lastly, non-trend days. I don't want to elaborate this, but this might be a pre-FOMC and neutral day. Nobody's in control. Neutral day has a little bit broader range than your non-trend day, but you get the main point that we can categorize these things here. So this is a very neutral day, and let's move on and look at some better concrete examples because these just happened here. So this was a classic trend day that we just had on the 13th of July. And what we see is that the market actually gapped up. This is day session only, which is just fine. It works just fine, especially, important for all you stock traders out there. And this is, you can see we hardly traded below the opening price. So what I've got here is this lovely overlay where we've got our 5-minute bar chart as well as the shape of the day as it formed in market profile. So we had a little gap up, and immediately we never traded below that opening price, and you had your strong drive. Now here's what's really cool, is watching the action relative to the previous day's value area or range. So you can see these little purple bars represent the value area or where there was the most trading. So we immediately drove outside of that value area on increase in volume, and then formed this broader line right up here, which was around this 1348 handle, which if you notice how we traded back and forth through that today as well. So this is a trend day up, and then what do we get the next day? This is where I like to add my 2 cents worth. That I call it a Z day or a consolidation day. Is very common after you've had this markup period that we continue to fill out this range. And look how nicely it shows the support level or resistance level with the market profile clusters as well. All right, so for those of you that prefer not to look at the actual market profile type of format, let's translate this concept into more of a traditional bar chart, and I'm just going to use 30-minute candles. And again, let me repeat to you that Chris Terry made this chart for me with this lovely market profile software on TradeStation. I don't look at it during the day, but that doesn't mean that it doesn't have value. I think that as you study the charts, you'll get very skilled at being able to see things with 2 different pairs of glasses. You'll get the basic idea, which is what I wanted to convey to you, thinking in terms of concepts. So this is that same period here now on a 30-minute candlestick chart. And this, once again, is the pit session only. So this is the same period where we had our gap up and that strong initial drive, that open drive sequence, which led to closing on our highs. This was another trend day too, where we actually had a gap up, and then we ended up taking out the low of that first 30-minute bar. So it wasn't quite the open drive sequence, but you formed a little initial balance here and then broke to the downside into that previous day's range. And of course, closed on our lows. So watching this first 30-minute bar, and is it an open? This was a gap outside value area 2. So gap, test, reject, or gap, drive, and then see how it unfolds from there. And here you can see we open and then form trading on both sides of the opening price. So once again, this is what it looked like in the traditional profile format. And you can get a very similar feel looking at 30-minute candlesticks. You know, the whole idea of trading, let me just take a moment and give a little digression here. You know, there's so many different setups and patterns during the day. It is overwhelming. A lot of our time is spent nickel and diming. I kid you not. This was very much how floor traders make their living. You buy the paper and flip it out for a tick. You know, maybe you scratch if it doesn't go anywhere. A lot of time is spent treading water, if you will. Okay? Not every day is this huge profitable day. Maybe 80% of your days are not wildly profitable. But the whole secret to the game is just waiting till you see that one opening. It does take patience and a certain amount of fortitude, and sitting on your hands and not over trading when it doesn't call for it. Just waiting for that one recognizable thing. And I'm sure that over time you see that perhaps the bulk of your trading profits might come from 2 or 3 exceptional days or 2 or 3 exceptional trades. You see, so if you can just think about capturing a piece of a move like this and letting a profit ride maybe 1 out of every 40 trades, you see, maybe you'll have 10 setups like this and you'll only get a piece of 2 of them. That's fine. But over time, you recognize this more and more. And so that's why I think that if you understand the concepts behind this and just don't get too caught up in like little 5-minute bar charts and oscillators, even though oscillators have huge value in terms of recognizing momentum, it just takes, you know, it just takes a couple times and feeling confident and getting a better win. So this was that day that the market actually gapped up outside of this previous day's value area. See, we opened up here well above this, and we immediately plummeted right back down to, again, remember that point of control definition or node or high volume node tends to be a little bit of a magnet. So we made a beeline back down for that magnet, filled this out a little bit, and then of course fell down through it. And once you fell down through it, bam. Trend day down. What do we look for the next day? At least some consolidation before you build a base for the rally back up again. And this was just one last day that you can see the little pauses along the ways and how it looks in a bar chart format versus this elongated range expansion type of thing. And you'll see very quickly when you look at market profile charts, the alternation between the way they form these big clumps, if you will, in theory a bell-shaped curve, but it's not more often than not. So you alternate between that versus that. And so a lot of times at night, if you were going through looking at market profile charts, just look for the little clumps or the little narrow ranges where it builds out a nice big fat point, and then that's a market waiting to move out of balance the next day. So I just wanted to show this. This was an EC chart. You can see this is a 5-minute time frame. And again, I just wanted to address this issue of the 24-hour session. Doesn't matter. We have a couple things going on. You can see the way that a trading range or a consolidation, value area, whatever you want to call it, doesn't really matter, has formed here. All right, it's not as visible, see, on the 5-minute bar chart. You really don't see it the same way. Okay, you don't see it the same way. But this was filling out from the previous night's trading. You see I've got this session opening in the evening here, right at midnight, and then boom, it's filling out in our morning session. Of course, I'm sure there was probably a 9:30 number. I don't know. It doesn't matter. Really, news doesn't matter. What does matter is the sharp impulse up and the fact that we broke out above this area. Okay? So this, in market profile terms, would be called single prints, single time frame trading, all market participants dogpiling in the same direction. This is just 5-minute bars. And then when you see that, when you see the sharp markup, if you start holding for a couple bars, more likely than not, we start to fill out another range. So I know I skipped through a lot of things pretty quickly, but I wanted to take time for questions. And let me just summarize briefly what are the main points that I wanted to convey. We all like to use the swing trading as structure. Okay, are we in an uptrend? Are we in a downtrend? Where's the swing highs and lows? Where can we test? So forth, so forth. These are the most visible points, and I think that they dictate the market psychology. And I think that they can be the basis for our trades. So at night, when I do my homework at night, I'm looking at the swing charts, the highs, the lows, the bar charts. Is there a loss of momentum on the daily charts? Are we forming a bull flag or a bear flag? Is there a big broad triangle where we can break out from? All these traditional classic things, all right? But when I come in the next morning, how am I going to key off that early action, all right? And the things that I'm going to look at are going to be more from the market profile set of semantics. Where does the price open? How do we trade off of that opening? Is there an increase in volume and range expansion indicating that we've got institutional players behind us? Or is it more rotational chop chop? If it's a more rotational chop chop trading range day, I want to be careful about not getting caught up in looking for short-term bull or bear flags or continuation patterns. I'm going to be more likely to look to make counter-trend trades, perhaps buy or sell divergences at the tops or bottoms of the range, and I'm going to be much more aware of what type of day is likely to form. And conversely, if I come in and I start to see a big open test reject sequence, or for example today where we had news and we had a false breakout to the upside and then that false breakout to the downside, I have to be aware or conscious that these types of big swings and big rejections very often come off news. So be skeptical. Be skeptical when you start to see some of these exaggerated movements coming off a news environment. All right, you need to make sure that if you're going to trade a continuation pattern that's off news, you truly form enough price bar overlap to indicate a good type of flag formation. And if you actually look at the trading that we did down here, all right, I know this is a 10,000 tick chart, but we didn't really form enough trading down here to lead to the continuation to the downside. It was a big radical one swing and then the swing in the other direction. And keep in mind that this type of pattern does not happen that often. So with that, both of these things are important to remember, that we are here to follow the markets. Market profile can't predict any better than a swing chart can predict. None of them have any great forecasting value, They're just going to simply say, I want to trade with a long side bias because the trend is up. Or I want to trade a long side bias because we're testing support and I have a great spot to manage my risk. Or I want to trade with a long side bias because I've got an open drive sequence. Or I want to trade with a long side bias because we have a light volume day, it's a trading range, we just tested outside the lower end of that value area and we're starting to come back up into it. And of course, vice versa for the short side. So once again, no forecasting value, but they give us our initial bias in terms of a directional sense, in terms of support and resistance, and they give us initial bias in terms of our strategy, counter trend, or continuation and follow the trend for the day. The big money is made for day traders when you can capture the trend for the day. That means pressing a winning trade where we have an increase in volume. Volume makes everything easier. All the patterns are clearer, the swings are wider, the targets are broader. Volume makes everything easier, and we only get those choice volume days a certain small percentage of the time. So the rest of the time is sort of nickel and dime stuff and staying in the moment. So follow the market, see how it tests around previous swing highs and swing lows. See if it's a, how it trades back into the previous range. And that's very much what we do as traders. One swing at a time, one moment at a time, and how does the market trade around previous important areas. So I hope that you see that for me, it's really a very simplified process. I don't want to be doing analysis during the day. I don't want to be throwing up Gann lines or Fibonacci lines or doing anything that involves me taking my mouse and rearranging charts and doing too much clicking. Because when you're clicking with your mouse and playing with stuff and moving stuff around, it takes you out of your trading mode, okay? Your trading mode, you're watching, you're stalking, you're concentrating. You're not typing online to your buddy. You're not talking on the phone. You're not surfing on the internet. You're watching the price action to see if you've got a trigger, and for best execution, and execution skills take concentration. So I need to reduce everything down to very simple swing highs, swing lows. I like the fact that we can use an hourly chart. Okay, is the swing ready to turn up? Is there a loss of momentum at that hourly swing? Very easy to put up a little, momentum oscillator or stochastic or whatever tickles your fancy. And then again, I just encourage you to, find your own formula for taking the best of each technique or concepts and make it your own. Anything that you heard from me today, write down, follow, see what works for you, see what doesn't work for you. There's a lot of people putting out a lot of information out there. Sometimes you might just get one nugget from one person. It's like an aha moment. Aha, that makes sense. Yes, that's a little reminder. It's a little reminder that we can have this. And again, I love that Dalton book as a reference. Don't get too caught up in worrying about all these different profile patterns and this and that, because there's a lot of diagrams in there that trust me, I'm blonde, they go in one ear and out the other ear. But I did like in the first third of that book the way he talked about the price could trade off the opening and the types of days that can form. So let me just see if I've got some questions here, since I just have a few minutes left. A good question. How many time frames do I look at during the day? I like just a simple grid. I'll show you something cool here. A simple grid. You can use a 5, 15, 30, 60, whatever. I love an hourly chart for stocks. I love a 120-minute chart. And I think everybody likes 5 and 15-minute charts. So if I had a grid up, let me see here. Let's see if this actually shows here. Okay, can you see this? All right. This is a simple grid, and I love the fact that with TradeStation you can set up all the symbols on the left-hand side and click. All right. See, it just changes everything so nicely here. By the way, I drew these in for you. I don't normally have these here during the trading day, but I like to look at the overlays like this. Sometimes I look at a grid like this because I like to look at all the markets for confirmation or non-confirmation because I do trade most of these markets. So I like to see the Canada, the Aussie, the EC. I like it when they all start moving together. Then I'm like, okay, let's go put the trades on. You know, the volume's coming in. Go. You'll see on the lighter volume days, you start to get one sort of up, one sort of down. You know, a lot of fluctuation there. So I don't think you can process all these charts individually. It's just kind of like looking at a mosaic to me. So here you can see on the indices these 5-minute little white thing there just represents that I've got a little bit of a loss of momentum. And the purple bars, I color coded those purple to indicate that it was a push outside Keltner channels, so it had to move a certain ATR function, and also the oscillator had to make a new swing high. So that just indicates momentum, and you know that if I get that you're still going to push a little bit higher. That's all that means. So I'm sure that everybody has their own little ways of looking at information. Here's another page that's pretty nice. I like using this for the indices. Let's see here. Why is this here? At any rate, you get the idea. I always like this 5, 15, 30-minute grid up. You know, very easy to construct your own, and I like to see all pushing back up into that previous day's range. You see that? So I think this is pretty standard way that you can use your TradeStation. And then if I wanted to see the say an hourly chart, it is very easy for me just to type bingo, and they'll all change to hourly charts. Okay. Yes, I showed a market profile on both a 5-minute and a 30-minute chart. There was a question on this here. Let's see here. Is there a time when I use one over the other, or do I recommend one over the other? How do I watch the last price, the tap all day, when I'm not near a swing high? Usually when I'm watching the markets, I like to look at the quote board. So I am very much one that likes to watch the last price. That's me. And you'll see with the TradeStation, it'll flash a color when it's making new highs or new lows. So pretty much I like watching that quote board. And in terms of the market profile, like I mentioned, I don't really use that during the day, but if you have a program that breaks out those bars, for example, let me go back and show you on here. Chris Terry works with us in the trading room that we have, and he loves this particular software, and it's free, and I'll see if TradeStation that volume at price, low volume nodes, high volume nodes, blah, 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 are the more modern way of using market profile rather than the traditional TPO charts. Even Peter Stottlemyre is working on doing more with volume now in his latest work, from what I understand. Okay, here's my thoughts on all of that. There's a million ways to skin a cat, all right? Trading educators are just that. More often than not, they're educators. They're not traders. There's nothing wrong with that, because I think it's wonderful to have an educator that provides an objective eye. But you, as a trader, needs to find what rings home and makes sense for you. So, like I said, it's a matter of semantics. Do not let it confuse you. All right? High volume node. What is a high volume node? Take a look at this chart. All right? This is a high volume node. Can I just say one word? Duh. Okay? Duh. It's the middle of a big fat trading range. It's a consolidation. So if you want to do more fancy statistical work, you can sit there and, look at the TPOs, and are you calculating it off of volume, or are you calculating it off of the number of trades? For now, I think it's important, get the main idea right, that this was an area of a lot of trading, a lot of consolidation. If we push away from that and are going to have continuation, you need to have volume to support that. You don't want to die out at the top of the range, and vice versa. I just like to joke around and have fun. All these people in the industry are friends, and I just really want to drive home the point that everybody needs to develop their own methodology and roadmap too, and take an idea here or there from somebody that you hear a presentation from, and there's value in all of this. What is the blue indicator at the bottom of my charts? That is a 310 oscillator. So, for example, I go back to this desktop sharing where it's this image here. In this case, I made it so it's green when it's above and blue when it's below. It's the difference between a 3 and a 16 period simple moving average. It'll look very similar to a 7 or 9 period stochastic. And I'll tell you what, I will do another presentation at a later point in time for you, going over more traditional oscillator patterns and the way that I use them. For Forex, do I use volume in the chart? From what I've learned, volume is not used in Forex. Volume is a very tricky thing with Forex. You're right. Again, I'll just go back to what I was saying. I think volume shows itself in global capital flows, and those flows will include the stock market. And also volume is very highly correlated with range more often than not. So if you have a big range bar, it's going to have an increase in volume on that bar probably 90% of the time. As an aside, when I say range, I am strictly speaking about classical range, high to low. I do not use range bars. I do not profess to be proficient in that area. You know, pick one tool and stick with it, and if it works for you, that's the whole name of the game. The email address, lbrgroup@att.net. I believe on my website, which we're in the process of redesigning, there might be a button there where you can email and it'll go to feedback at LBR Group. That also will get to me. It will also get to Chris. My website is LBR Group, or you can just Google my name. One way or another, I will get your emails and get that code back to you. So 90% of my presentation, you could not see my mouse. That's okay because I really wasn't using my mouse. Again, hopefully you can get a chance to go back and review these slides. And, you know, sometimes a picture shows, what is it? A picture tells a story, right? Okay. Other than volume, what do I look at to decide if it's a trend or a consolidation day? That's a good question, and here are the answers. I look at the previous day. Okay, did we just have a big range expansion day? What is the overall broad structure? Are we in the middle of a 10-day trading range, or are we just starting to thrust out of that like we had with the grains, where you've got a very outlier, trendy type of move? Okay, so I want to be aware. Remember, at night, I'm looking at my daily structure. Okay, are we doing chop consolidation after a big markup? So first off, look at the previous day. If that previous day was a narrow range, very choppy day, and you might have 2 or 3 days overlap, then the odds of having a big bar range expansion increase. So that's number one. Number two, once again, be aware of the market correlation. If you start to see activity in the currencies and the bonds and the gold and the crude, you've got greater odds of having better movement in the E-minis as well. So hopefully that will give you a clue. And then lastly, remember the importance of the first 30-minute bar. Remember the importance of seeing how do the time frame players step in. Do we have institutional players right off that first 30 minutes? You know, and so forth and so forth. Let's see. One more question. Market internals. Yes, I tell you, the market internals are always important. And the market internals, to summarize the main things that we can use, breadth. Breadth, always very important. And more important, the trend of the breadth. Because obviously, with the gaps up and down nowadays, we see extremes in the breadth on the opening. So it's never the absolute level, it's the trend of the breadth. Or is it staying high or staying low? Second one, of course, volume, I would count as a market internal. Third one, the RVX and the VIX are very useful guidelines. For example, this afternoon we rallied up and the RVX was actually rallying, saying that there was not going to be much more upside to the market's activity in the afternoon. As opposed to sometimes in the afternoon session, you can be sitting there consolidating sideways and the RVX will be dropping, 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 saying that we're going to have an upside breakout. So yes, those are important. And then the ticks are different patterns than they used to be. I could talk 4 hours on ticks. We see the extremes in the ticks made in the last 90 minutes of the day now, whereas 10 years ago they were made in the first 90 minutes of the day. A big change there. I use them more as a momentum oscillator, as an indication that there's program activity around. And again, I think ticks need to be put in a context of, you know, are we moving towards opening price or away from it? And are we above or below the opening price? So there's a lot of subtle things there. The trend I'll look at. I always make sure that it's not distorted by a particularly ridiculously huge issue out there. So yes, we could do a whole session on market internals. Boy, TradeStation's just going to have me as a regular presenter here, right? You know, I can do stuff on oscillators, chart formations, market internals. But with that, let's wrap it up today before I muddy the waters any further. Send me an email or go to my website and send an email there. I will send you that code. Please do not ask me how to use it because I did not create it. And Chris Terry is the one who's most proficient with it. And TradeStation has something very similar to this type of format in its application. And I know they've gotten increasingly sophisticated all the time in offering new tools. And so I'll let you play with that yourself. Again, thank you guys, and I will see you later online.
Thank you, Linda, for your presentation, and thank you everyone for attending this evening. If you are not a TradeStation client and you would like to know information about how to open an account, on the slide in front of you, you can see information on how to do that. Also, please make sure to check out upcoming events, and I'm going to go ahead here and push through a couple of links for the TradeStation website where you can sign up for other events. So thank you again for attending, and we'll see you soon at another TradeStation event. Have a good night, everyone.